interesting topic on the AI and the growth of the AI in the financial management spheres. Ron, we will start with you. You got a little urgency shortly after, so I will start with you. Can you maybe introduce yourself a little bit, what you do? And then I directly have one first question. If you can share a little bit more about the machine learning topic that we also just heard about, how to make sure that you enhance your AI tools to get better outcome of than just using AI alone.
Sure, great. So thank you. And I'll start with sincere apologies. I'm going to have to run in 7 minutes. My name is Ron Daniel. I'm the CEO of Liquidity Group. We are both machine learning / AI due diligence platform developers. We have patented platforms that today few tier one banks are using to deploy capital both on credit and equity. And we also have an asset management business with a few $1 billion that we deploy capital to a more risky area that we examine around tech, late stage globally. We work in 65 countries, and we deploy a few $1 billion a year to examine our models. So we are strong believers that when you develop AI models and machine learning models to do analysis and to get decisions, you have to first prove yourself on your own capital. That's why we started the asset management business. It's grew up tremendously. It's demonstrating a steady yield over the last 6 years with 0% default rate in some of the riskier area in the world, business areas, of course. This day we are finalizing our next product, which is a combination. The first time we are actually using LLM models, generative AI models, directly inside our machine learning models. And that's a very important point to discuss, because everyone talk about generative AI, but generative AI at the end of the day, it's a language models. It's a guessing model, and it has about 5% hallucination rate when it's come to data analysis. And so it's guessing, and it's relatively guessing quite well, but it's still a guess. It's not in a quality that a serious financial organization can build a portfolio upon. And that is an issue, right? Because everyone wants to be as part of the trend, but the trend is not good enough yet. And how can we train it to be good enough? The only way to do it at the end of the day is to use what's really working, which is the financial analysis machine learning models, to fine-tune the generative AI models all the time. That's what we do. So we build a platform which is basically a multi-layered platform. It starts with the financial analytics and predictive analytics layers of our analysis when we see a company and we see a market. And then we feed the generative AI specific values that he can speak about. Okay, because we use the generative AI basically to communicate the decision to multiple layers in an organization. I'll give you an example. Let's say that a big bank in the world wants to invest in a public company and track his investment and define his client relationship strategy. Today it's being done through multiple analysts that copy paste all this different information from various sources, but it's not really a smart machine, and it's very, very expensive. With the new technology, it's becoming to be something completely different. They understand that they can generate the report automatically or semi-automatically and save a lot of cost and be more coherent over the hierarchies using generative AI, but the data is just not there, right? You cannot trust that the analysis will be accurate enough. So this is exactly where we comes in. We integrate the prompts into the LLM models and basically helps them to use more accurate specific values, both on the analysis of the company, the market, the prediction aspect, the tracking aspect, etc. And I think this is where the market is going. So we see these generative AI solutions. I capture them more as part of the infrastructure, right, of the data center infrastructure. It's going to become very general commodity very quickly. Price going to drop of all the IT around it, and eventually the expertise will come as a layer on top of it, which is a vertical expertise that using more traditional machine learning. So I know it doesn't sound, I'm sorry for the word, as sexy as just generative AI, but generative AI are great will if you have a great engine. And
That's a
where we
great
stand with that.
explanation. Yeah,
Yeah.
thank you so much. Thank you. Dr. Hassanat, you also please introduce. Oh,
Can I
thank you
use
so
this?
much.
Yes.
Yes.
Thank you guys. Thank you so
Thank you.
much.
Maybe you can also do a small introduction, but for you, we spoke before about that you're mostly focusing on the risk analysis, that you're using your AI models to look into portfolios. Can you explain a little bit more what you do at IDI?
Right. So IDI is actually an Abu Dhabi company. We're based right here. We're an ADGM company. And we are focusing on AI-powered fintech for the private market, okay? So we focus primarily on the private market. Why the private market? Because it hasn't developed. It's a very important market, and it just hasn't got the technical capabilities around it as it exists in the public markets. And there are lots of reasons for that. Fundamental reason is that public markets are very thinly traded, if at all. And when they are traded, it's usually in secondary markets, and the data on those trades are generally not published. So the net outcome of that is there's not a lot of market data around the public market. And when I say public market, basically for those who might want to know what I mean, it's mostly things like startup companies, venture investing, private equity, and there's a long list. So IDI, we are not only focused on risk and portfolio management, we are actually even addressing some other core aspects of the problems around private markets. And so I'll give an example. If you look at private market investing, if you are trying to build a portfolio of startups, global startups, you really do not have, if you're a family office, for example, or a VC, you have very little ability other than traditional investment committee and smart analysts. You don't really have a lot of automation, not a lot of data-driven insights that can help you build your portfolio up and make sure that you are maximizing your IRR and other metrics that you want to maximize. And so we really started with that kind of a problem set. And again, because there is no market data essentially around private market transactions, we had to build a very extensive data layer, right? From global data from all kinds of sources, which is actually prerequisite to doing anything useful here, right?
Yeah.
Having done that, now we're able to actually build systems which are able to, for example, predict with good accuracy the probability of success for an exit for a startup. Or we are able to predict, for example, given different entry points, what is the likely multiple that you might get on a particular company. We can even predict possibly how long it would be to exit, yeah, and the list goes on. So having done that, we now have basically proxies for doing risk management, because if you want to do risk management in the classical way, you'd be doing you'd actually need price data and volatility and things like that, because most of the frameworks are around mean variance optimization or its derivatives. We think that just as powerful and maybe even more powerful are systems that approach it from a completely different way. And so we're actually taking this stuff that we're building up in terms of being able to predict the trajectory of a startup, for example. But if you do it at scale, so if we have, let's say, most of the startups in the world, we have our own view on them. We are then able to create portfolio optimization and risk management technology.
Very good. Yeah. I was very intrigued about the work that you and your team have been doing because, for example, at DHF Capital, we are a securitization firm in Luxembourg. And for over 8 years, we only have used public data. We use data from Bloomberg, we used other public sources. And we really see that for over 8 years, we have algorithmic. Now we call it more and more AI. Algorithmics are supporting itself. And the biggest question is this reliability, especially on the private sector. And I think you're the first person who I really spoke with that had such a big data set built to evaluate the non-public sector. Can you still touch on the reliabilities of the models in your framework? Because it stays with the data that's been provided to you. How is this trustworthy for a publicly traded company to make choices on?
So again, we are focusing right now on private on private companies, but some of the same ideas actually will translate to public portfolios as well. On the question of reliability, in our view is that really it's an engineering problem, right? Like in any other engineering, if you have a very, very complex system, reliability is really connected to testing. And if you can actually design the right kind of rigorous testing framework with the right coverage, and you're able to test it from multiple perspectives. So the broader your test coverage is, the greater your reliability will be, right? So it is true that we are still on the early stages of this journey. It would be incorrect to say that we have it all figured out. I mean, there's lots of very interesting things that are going to happen even in our own journey, and we're looking forward to it. But I mean, you know, given the kinds of metrics that you would look at from a statistical standpoint, in terms of accuracy, precision, things of that nature, you know, obviously those are your first go-tos, and you want to make sure that those are locked up as tightly as they could be. But then there are other things we also need to look at, because in the world of risk management, you know, there are other outlier risks, tail risk, and you know, event risk, you know, things that you don't normally quantify, but they happen. Are there ways of incorporating them inside an AI-based framework? You know, we believe that there is, and again, I'll state the obvious. It has to do with the data, and the trick is really understanding which data has this signal and to what degree, and really creating that full understanding. And this is a continuing journey. I mean, we're not going to get to the end of this, but we are making progress in trying to understand the signal content of various features that we either you know, get, or we create, or we engineer. And as we get more and more refined in this, I think the reliability of the models are going to get just sharper and sharper, and we're going to be able to bring in more factors.
And
besides traditional.
you're testing those models for a long time. So talking maybe shortly on a very other hot topic, especially with the COP28 next week starting in Dubai, the sustainability part. When we are using AI, we use a lot of data centers, we use a lot of technology, we use a lot of energy.
Right.
Are your models optimizing itself to use less and less resources when you are doing this long-term testing with your data set?
Yeah, I mean, that's an excellent question. I mean, it's sustainability, and it's also cost. I mean, if you're not careful, you can be in a lot of trouble, because it's very expensive. The computational complexity can outrun you, no matter how well funded you are. So I'll give you a couple of insights that we have gained. So one is from the what is publicly known. So, for example, many of you know that in recent months, the Bloomberg GPT model, it's a general language model as well as a model that is specific to the domain of finance, and it's trained on the incredibly large corpus that Bloomberg has gathered over I don't know how many decades, but many decades. So it is a really amazing thing that they've done, and I've seen some of the results, and it's very impressive across just standard LLM, natural language type scenarios as well as finance scenarios. Now, looking at that, there's like a pretty robust movement right now in the open source community from very credible computer science, machine learning, AI people, and finance people. And what they're saying is that, okay, I mean, Bloomberg can do this because, by the way, one run of the Bloomberg training thing, you know, by different accounts is between $3 to $6 million, just one training run, right? So then in the open source community, what they're doing is there's a lot of push to get data open source that is finance related, having a competitive corpus that's open source, but also creating financial LLMs and a financial GPT framework. And I think these things are going to actually take off, right? So, but one of the things that I was very encouraged to see that these guys are doing is they're paying attention to the tuning of the model. So it's not like you have to build a fully trained large model for every subtle use case. You can probably get away with doing that once and incrementally retraining it. But there are other cheaper options, more optimized training options around. So like LoRa is one, is low rank adaptation training. There are many others, which basically are very objectively train certain layers of the deep network and get very good results. So what I'm saying is that there is a lesson to be learned. The technology is coming up with its own understanding the limitations of cost in training and impact on ESG and environmental costs around electricity and so on and so forth, consumption. There's a lot of attention to how training can be done in a much more intelligent way. And so that's happening in the industry at large. At IDI, we are learning from them. Now we are a small company, we're a startup. So we are learning from the research that's happening in the big sphere, and we apply elements of those kinds of things in our own own work.
Very good. My last question was what the future potential you see, but you answered that perfectly already, and we have to wrap it up. I want to thank you so much for joining me today, and thank you guys as well.
Thank you.